I think the earnings season's been okay. The numbers are coming in better than expected, but the numbers were slashed significantly coming into the earnings period. So when they were cut by 600 basis points, we're up by 150 basis points. Usually we're better off than that at this point in the earnings season. Look, I think that things are better than feared, so that is good news. Even though out-quarter numbers are coming down still, and they're coming down quite significantly, the market's still reacting positively because I think there's bigger issues in the market. The Fed is still holding pat. The question is on trade, and stocks are I think, pricing in to some extent that a resolution to trade will come near term.
And where's the guidance pointing us so far?
So far for 2019, we're looking for 3.5% growth, and that is down quite a bit from 6.5% at the start of the year. Usually in a full year period, you see numbers come down by 5.5 percentage points, so we're already halfway there. We're only a month into this thing.
Kevin, when you consider the sort of broader outlook for U.S. equities, do you feel like most of the potential good news we could have had, we've already had when you factor in earnings and the Fed, it's sort of just holding out for a trade deal?
Yeah, I mean, I think right now we're range bound on the S&P. We have said that it's been in the range of 2,600 to 2,800. At this point of the rally, it's going to be tough to get over 2,750, I believe, and we may get up to 2,800. But the big deal here is that what we really need is trade resolution, or we need more stimulus from China to actually start to feed through. So we really need some more news to come out in order to see the S&P propel to levels higher than that 2,800 right now.
You know, Rick, it's hard to keep track of the economic data with so many delays and readings coming through. What's the latest in terms of what you're getting? And how much do you think that jobs report, so strong and so unexpectedly strong in the middle of the shutdown, really sets the tone on the data?
It really does set the tone on the data, but I'm not so sure if it's just because it was strong. We averaged 263,000 over the 2 months when you took the revision and added everything together. But I think the issue is twofold. The reason, you could call it coincidental lagging indicator with respect to employment and jobs, but the fact that we're doing so well, so quote unquote late in the cycle, especially when compared to the birth rate, and then when you look at the actual numbers to see wages so firm, so many months in a row, average earnings year over year have a 3% handle or higher, not pushing into inflation. And you see the labor force participation rate and labor force to population ratios moving lower. Those are very structurally important fundamentals we garner from that data above and beyond just the job creation. And to take it a step further, even though our data is sparse, and even tomorrow I'm looking forward to productivity, but we're only going to be getting industrial and manufacturing productivity. But it makes us all concentrate more on Europe and the UK and Japan. And Europe, the EC released minus 1.6% on a month-over-month DC retail sales today. That is the biggest drop month-over-month percentage since May of 2011, and it's the 5th worst number in 20 years of data I have on retail sales in the Eurozone. And I only say that to underscore that as the Dow sits about 1,400 points away from all-time highs, our economy might not be cooking in grease like it was, but by comparison to the rest of our competing larger economies, it's doing much better.